Welcome to F7 Financial Reporting, reputed to have one of the biggest syllabuses in the whole of the ACCA qualification, yet it has one of the best pass rates. So I want to start today with three things. Number one, the syllabus. Number two, the examination paper. And number three, what we're going to do about it. Most important, of course, is the examination paper. Would you therefore turn in your class notes to page 6 as we have a look at the exam itself. Question 1, of course, is consolidations, 25 marks, of which 5 marks is going to be discussion, but it's mainly numerical. That is the coming together of several companies, certain techniques, believed to be the most complex area of the syllabus. Question 2 is published accounts, which is a trial balance with a few adjustments. Sometimes the examiner gives you a set of accounts and asks you to correct it to curb abuse, to correct creative accounting. That's question 2. Question 3 is cash flows or ratios interpretation. Sometimes it's a combination of the two of them. Question 4 and 5 are on standards and on conceptual areas, mainly written. The whole paper is written, of course. But there are some numbers as well. But I think it is just about possible to get your 50 marks out of the 75 just looking at questions 1, 2, and 3. What is troubling me slightly from a student's point of view is that these days standards has affected questions 2 and 3 as well, so you need to study the standards to give yourself a good chance on questions 2 and 3. So that's on page 6. The other issue I ought to raise is how we're going to spend our time together. The first phase is the tuition phase. The second phase at the end will be revision. Now, the examiner has been in charge of this paper for many, many years, and if you want to see what he looks like and his feelings about the paper, I'd like you to look at the next 7 pages. Every time I meet the examiner, you can see him on page 13, I get the impression that he is a very kind and sympathetic person. He is the longest-serving ACCA examiner, very successful in terms of keeping the pass rate high, being very fair with his papers. We have a bit of dialogue, meetings, and a very good examiner, I would say. Now, I did not introduce myself. My name is Francis Braganza. I've been teaching for many years. I won't tell you how long, but I will tell you how successfully. Someone worked out recently that somewhere in the region of 25,000 students have passed with me. Now, the most important thing is that you should pass. So what I'm going to do is to share with you my experience, my techniques, the structure of how you approach your questions to guarantee a pass. The most complex part of the paper is obviously the question on consolidations. So what is consolidations? It's the coming together of several companies. You have a parent, a subsidiary, an associate. Certain techniques are used, certain accounting standards. Now, do we use something called acquisition accounting or merger accounting? You might ask, what is the difference? Let me give you a scenario. I'm swimming out at sea, below the level of the water, and as I swim out, I see a fish swimming towards a lady swimmer. They meet and become a mermaid. Now that's a merger. But as with most mermaids, mergers are mythical. Now, I continue swimming out at sea, and I see another scenario developing. A large fish is swimming towards a smaller fish, and the large fish gobbles up the small fish. Now, is that an acquisition or a merger? Would you agree that in time, all you see is the big fish? And that is truly what is known as an acquisition. The fish that's eating up the smaller one is the parent, and obviously the smaller one, the subsidiary. And this is the basis of what we're going to be doing as we approach consolidations. Now can you turn to page 15 as we attempt the technique if I show you how to do these consolidation questions. Remember, it's question 1 in the exam. The entire paper is compulsory, but this is probably the first thing you will attempt. The consolidated statement of financial position, sometimes called the consolidated balance sheet, the name has changed recently, is what I'm going to show you. If you turn past the first couple of pages, you can read that at your leisure. What I've done next is to show you a past examination question to show you what the mountain is like that we've got to climb. That is the level we've got to achieve somehow. So I'm going to take you through the foothills, and gradually you'll reach that high level while we're doing revision. So that is on page 17 and 18. I then summarize the question, the main bits, on page 19. Turning on, therefore, to the statement of financial position consolidation. Do you know that the parent company has control over the subsidiary, and the group has no legal status? You cannot sue or be sued by a group. Beyond that, there are some definitions which I'll leave you to look up, but crucially on page 22 you have a technique that I'd like you to use, please. There are 3 steps. The first thing is to open up your consolidated statement of financial position. It used to be called the consolidated balance sheet. Leave it blank initially. Thereafter, your second step is to open up workings. Now, within your workings, there are 3 steps. The first step is obviously to open up your group structure. Is it an 80% type of subsidiary? Is it a 75% subsidiary? That kind of thing. So when you start your workings, you do your group structure. The second thing you do is your consolidation adjustments. And of course, something called the net assets list, as I'll show you. Once you've got that organized, you do something called the big 3: goodwill, non-controlling interests, and consolidated reserves. Now, the non-controlling interests has recently been changed. Now, a few minutes ago, we looked at something called the IFRS 3, International Financial Reporting Standard number 3. That has changed, among other things, the minority interest expression to the non-controlling interest. As you'd imagine, the parent is the controlling interest, and so the non-controlling interest is what used to be called the minority interest. Now, initially, as the exams unfold, the examiner is going to be quite relaxed about whether you accidentally say MI instead of NCI. He doesn't mind that too much. But it's the technical side where, as I'll show you, the non-controlling interest gets involved in things like goodwill. Those are the aspects that will carry marks. So terminology doesn't matter, but the technical accounting side, of course, does. So the new IFRS 3 has changed certain things. So moving on to the big 3. In fact, what I could put on the screen, if you'd do it with me, please. I'll call this the big 3. Goodwill NCI, we can say in brackets, was called minority interest. And as I say, if you accidentally use the wrong expression, the examiner doesn't mind. So, once that's organized, you come to the third step,
after you do your workings, come back to the consolidated statement of financial position to complete it. Don't forget to add across. Now, the examiner has this view, which I subscribe to myself, and that is if the parent has, say, $100,000 of non-current assets, and the subsidiary has, say, 80,000, when you add them across, you have 180, and that is the act of consolidation. If you leave it to the examiner, the marker, to add across, to a large extent you aren't answering the question. You haven't answered the question, because consolidation is the act of adding across. So you start with the parent, say 100,000, the subsidiaries say another 80,000. If you don't add across, you have not consolidated. So do try to add across. Time will prevent you adding everything up, but certainly you must add across. If you can add downwards as well, that's even better. So don't forget to add across. If the CSFP, as I say there, does not balance, don't worry. I was at an examiner's meeting not long ago, and he was showing us a typical student's performance, talking about a performance. And he said that a student introduced at the end of what used to be called balance sheet in those days, at the end of the balance sheet, the student has introduced a suspense account to make it balance. In other words, the top half of the balance sheet, as it used to be called, statement of financial position today, comes to whatever figure, the total assets. You then come to the second half of the balance sheet, and because it doesn't balance, the student has introduced something called a suspense account. And obviously this student is obsessed with balancing the balance sheet. Don't forget that balancing the balance sheet, if it happens, it's great, but you pass or fail based on your knowledge of the principles. Do you have a well-practiced technique? Is that what you're showing the examiner? That's what you pass on, not balancing the balance sheet. This isn't F3. This isn't the lower levels of accounting. This is quite a high level. So as long as you show a good technique, you'll be fine. Don't be pedantic like the person on the next page, a typical accountant. If it doesn't balance, it doesn't matter. Move on. Because your 45 minutes is going to be quite tight anyway. Right, now, let us move on, therefore, to the next section where we have to demonstrate our key workings. The first working, obviously, is the group structure. Make a note of the consolidated statement of financial position date. Determine the non-controlling interest, NCI, in the subsidiary only. For example, if the subsidiary is owned to the extent of 80%, the MI, the NCI, will be 20%, obviously. So do that first. Organize your group structure. Now, in the exam, there are 3 key checkpoints that you must be careful to look at. These are mostly quite advanced points, a bit too early for us to look at this stage, but one day we have to face that exam. And so would you stop the tape now, please, as you look through the rest of that half page, points 1, 2, and 3. So let's look at the consolidation adjustments, fair value adjustments to the non-current assets, post-acquisition depreciation, that kind of thing, provision for unrealized profit, as I'll show you later, and intercompany payables and receivables. Don't forget, one of the crucial points with consolidation is that if you, the parent, is selling to me, the subsidiary, the group as a whole doesn't recognize transactions like that. It must be the group trading with the outside world that matters. So do be careful of that. Gradually, I'll show you how to cope with that kind of adjustment. So under consolidation adjustments, you have 3 main adjustments that the examiner goes for. Fair value adjustments, provision for unrealized profit, or PUP, and intercompany payables and receivables. Those 3 come up in every sitting, especially where you have a statement of financial position type of question. We come now to the net assets list. all those adjustments are summarized in this net assets list. This is prepared for the subsidiary, for the associate, and so on, but not for the parent. Now, what's the difference between a subsidiary and an associate? Subsidiary, of course, is where you have more than 50%. Associate is where you have between 20 and 50. And if you have less than 20, it becomes just an ordinary trade investment. It's a very simple idea. So you never do non-controlling interest, NCIs for associates, as we will see. You only do NCIs for the subsidiary. You've done your group structure, you've done your adjustments. We're now going to summarize the adjustments in this net assets list. This is absolutely vital. So, let's have a look at the acquisition. As you can see on the screen, the ordinary share capital is brought in, sometimes called the equity share capital, of course, is brought in for the subsidiary. Now, the nice thing is the two figures will be the same at acquisition as well as at consolidated statement of financial position date. The examiner has said to us that he will not set a question where the subsidiary issues new shares and the parent doesn't buy those shares, and thereby the percentage changes. For example, if you have 80% of my company, a little later if I issue some more shares which you don't buy, it's possible that 80% might become 75%. That kind of question will not be in the exam. It'll be 80% or whatever it might be throughout the question. So the share capital will remain the same. The next item, the retained earnings, is usually stated in the question, or you can easily calculate it as we will see, but be careful with things like time apportionment. So let's underline words like time apportionment based on the date of acquisition. The fair value adjustment, FVA stands for fair value adjustments. This is where you might revalue a building, because remember the cash you give to buy the subsidiary is based on the latest market value of the company, of the subsidiary. And so if the buildings are at some old book value, they need to be restated up to fair value. So you have to carry out what's known as a revaluation or a fair value adjustment. So that's one of the key points. Now the examiner will say to you the fair value adjustment is 100,000 or whatever it might be. So you bring that in at acquisition as well as at consolidation date. Obviously, if you bring in extra value at acquisition, after acquisition, post-acquisition, you need to bring in some depreciation on that extra value. That makes sense, doesn't it? It's absolutely logical. If I'm, say, my buildings are worth, say, 500,000, and you bring in another 100,000, my buildings are now worth 600,000. That extra 100,000 then needs to be depreciated over the life that remains of the building. So that is called accumulated depreciation. Please underline the word post. Highlight the word post, post-acquisition. And that's obviously done for the close of business as at the consolidated statement of financial position date, balance sheet date. So post-acquisition depreciation, notice, does not affect goodwill because it's post. Goodwill is done at acquisition and nothing after that can affect the goodwill. Then you have the provision for unrealized profit, as we will see. All these terms will make more sense as we do more questions. But I'm just introducing something that will work for the exam. So we're looking at the net assets of the subsidiary, and you're doing two lists, one at acquisition, one at consolidation date. So you bring in your share capital of the subsidiary, you bring in your retained earnings, and then you bring in the adjustments. Now, do you notice that all these things are added up? The acquisition date figures are added together, and this figure is used to calculate goodwill. So would you highlight kindly the word goodwill? The figure on the right, the total of the column on the right, is used to calculate the NCI, non-controlling interest. And the difference between these two, the difference between that figure and that figure, that difference goes to consolidated reserves. So, for example, if the column on the left comes to, say, 1 million, and the column on the right comes to, say, 1.1 million, the extra 0.1 million, 100,000, whatever it might be, must be transferred to consolidated reserves, as I'll show you in due course. Now, it's absolutely vital that you use these net assets. Now, over the years, I've taught T accounts for consolidations. I've even done spreadsheets and all kinds of different methods. But I do believe, after many years of teaching, this is by far the best method. I'll tell you why. There are two reasons. Number one, it's faster. And number two, it's more accurate. So it's faster and it's more accurate. That's a good combination, isn't it? So try to keep away from T accounts as we approach these three key adjustments, the big three as it's called. Now, I've left some of the original expressions in place. The minority interest strictly nowadays is called non-controlling interest, NCI, though I also need to make some kind of a connection to people who are more familiar with the older terminology. So occasionally I've just left the original in place, but if you can call it NCI, it looks a little bit better in the exam. So let's consider this new material. Be careful, this is new. And if you want to distinguish yourself from the average student, you must be aware of these new developments. This has been brought about by IFRS 3 as revised in early 2008. So it's all relatively new stuff. Right, goodwill. CI stands for controlling interest, of course. You start with the investment at cost, as given in the question. You then deduct from that the group share of the net assets at fair value at acquisition, and that comes from the net assets list. So did you see that? A little bit higher up the page, you have the net assets list. And so this particular item, this one here, is what we mean when we say from the net assets list. Very, very straightforward indeed. So you start with your investment at cost. You take away from that the group share of the net assets at fair value at acquisition, and that gives you goodwill. You then deduct from that impairment. Impairment is simply another word for depreciation. Now, be careful. This has been changed. It's a slight controversial change. Not everyone's happy with this. But when you're sharing out the impairment, or that the examiner gives you, they'll say to you impairment is this much, and you just have to share it out. You must share it out in the group structure percentage share. In other words, if the parent has 80% of the subsidiary, the NCIs, the other people must have 20%. So when you're sharing out the total impairment given to you in the question, 150,000, whatever it is, 80% of that, or 120,000, must go to the CI, controlling interest goodwill, and the other bit must go to the NCI goodwill, the non-controlling interest. So that's the end of the first step. We now come to the second goodwill. There are two goodwills these days. Now, I say to my students, people who've come from the old method to the new, don't worry about it. Look at it positively. Until recently, they gave you one lot of marks for goodwill. Now they're giving you two lots of marks. Welcome it, because you cannot get the goodwill wrong if you're a little bit careful in the exam. And if the examiner now gives you two sets of marks for doing the same, demonstrating the same skill, accept it with open arms. So you've got your CI goodwill, and then you've got your NCI goodwill. The NCI at fair value, which is the market price of the NCI shares at the parent's acquisition date. Don't worry about the complexity of the detail. I'll show you how all this works in due course. Less the NCI share of net assets at acquisition. And the difference, of course, is the NCI goodwill. You then take away the impairment, and that must be in the group structure percentage. So as we were saying earlier, if 80% comes off the parent's goodwill, the 20% of the total impairment comes off the NCI's goodwill. And so you have the net book value of the NCI goodwill. We then turn the page to have a look at the NCI itself. MI percentage, or strictly known as NCI these days. NCI percentage from the group structure, net assets at the CSFB date, sometimes called the consolidated balance sheet date. So initially I've used terms interchangeably to get you into this new idea, and then I'll be a bit stricter as we go along later in the handout. Now, a word of explanation. Maybe before I do that, let's have a look at what NCI involves. It's only in the subsidiary. You never do NCI in the associate, by the way. So you take your 20% from the group structure and you multiply it by the net assets list. If you go back to the previous section, the net assets, it's the list on the right-hand side. That goes to the NCI. So you literally take 20% of a figure that you've previously worked out. And the examiner gives you 3, sometimes 4 marks for that. What he's really giving you marks for is the adjustments, the fair value and so on. So be a bit careful with that, the provision for unrealized profits, as we will see. But it's fairly routine. The more questions you practice, the better you will get. And really, you cannot get it wrong in the exam. But stay away from T accounts. That's my big request to you. I know when I was taught this years ago, we would build up the NCI, in those days called the MI, line by line. Share capital, reserves, every adjustment split between the parent and the subsidiary. Between the parent and the NCI, obviously relating to the subsidiary. So every adjustment was split 80%, 20%, 80%, 20%. And it was very tedious. And the NCI would take half a page to do. Notice my method is just about a line in length, a couple of lines in length at the most. Very, very easy indeed. Now, just one other thing to look out for. You must also bring in, the NCI goodwill. You must also bring in the NCI goodwill. Now, this is new. Okay, a word of explanation. If there are outside shareholdings in the subsidiary, their interest should be shown separately in the consolidated accounts. Incidentally, all net assets of the subsidiary will be brought into the consolidated accounts in their entirety to reflect the fact that these are under the control of the parent. Do be careful of that. You bring in the parents, say, 100,000, and the subsidiaries, say, another 100,000, whatever it is, of plant, for example. So you add the 100 and the 100. And this is despite the fact that the parent only has 80% of the subsidiary. So you bring in the entire 100% of the subsidiary, and later you take out your NCI, as I'll show you. So all assets and liabilities of the subsidiary must be brought in, and the reason for that is the parent controls the entire subsidiary, even with a 50.1% holding. The examiner will not stretch it that far. It will tend to be something like 70, 80%. So anything more than 50% gives you majority control, and so you control 100% of my assets and liabilities. Never forget that point. And so, may I take you, therefore, to consolidated reserves, our next little section. You start with the parent's own reserves now, as per the Statement of Financial Position date. plus minus any adjustments, for example, things like the fair value adjustment to the parent, or indeed the provision for unrealized profit if the parent sells to the subsidiary. So those are little adjustments you might have to bring in. The only adjustment that is less important these days is things like dividends. The examiner doesn't go for that in any big way. But if, say, the parent gets a dividend from the subsidiary, you might, and it hasn't been recorded as yet, you might have to bring that in. But don't worry about that too much. It's mainly fair value adjustments and PUPs. So that's the parent's side of things organized. You then come to the group share of the post-acquisition reserves, and that basically means the net assets change. Do you remember the list of net assets we did a few minutes ago? You had the acquisition date and you had the consolidation date. And so the gap between the two represents the change in reserves. As I was saying to you a little while ago, the difference between the parent, the difference between the date of acquisition and the date of the balance sheet, the statement of financial position date, the difference between those two net assets is the change in reserves. And the reason for that, of course, is the share capital doesn't change. And if the share capital doesn't change, any change in the net assets total must be down to reserves. And reserves, of course, reflects any fair value adjustments, etc. So it's very simple. What you need to do is to master the technique, the basic technique, know it on the tips of your fingers, practice a few questions, and really you cannot get less than 70-80% of these questions right. The only constraint will be time, and that comes from doing more and more and more questions. So there you are. Let's have a look at this consolidated reserves. It causes the biggest problem in the exam, according to the examiner. You start with the parent's own reserves, plus minus any little adjustments, quite rare really. Then you say the group share, which is of course the parent share, of the post-acquisition reserves of the subsidiary. So you can see there, subsidiary percentage multiplied by the figure. That figure, of course, is the difference between the figure now at CSFP date and at acquisition. And the gap between those two figures multiplied by the subsidiary percentage is the figure on the far right. And then you take away from that any impairment of goodwill, which will be given in the question mostly. Just be a little bit careful that the impairment of goodwill is the parent share only. As we will see, the NCI's goodwill impairment goes into the NCI account itself. Now, what would like to say to you is that the parent plus any adjustments is like my first item to worry about in the exam. The next one is the plus bit from here to here. And the third one, of course, is the impairment of goodwill. So I like to think of the reserves as having three aspects to it. The parent's own, plus what the parent created by controlling the subsidiary after acquisition, minus any impairment of goodwill. Three items. Do you notice there are many threes in consolidation? As a little checklist, as you get familiar with the general scene, I want you to remember that overall we have things like the group structure, things like the consolidation adjustments, and then the big three. The big three obviously has got three aspects to it, which is the goodwill, the NCI, and the reserves. And amazingly, the reserves themselves have got three aspects to it. So if you approach consolidation saying to yourself, I must master these three steps, you're there virtually. One or two other interesting points, but let's go to this note of caution, which I've decided to bring in to save any loss of marks. Before we move on to the principles on which our workings are based, let me quote the examiner. Many markers reported answers with little or no workings, or with workings that were difficult to follow, and not reference to the figures in the answer. An incorrect figure in an answer will not be allocated many marks. Does it say many? It doesn't, does it? It says, will not be allocated any marks, unless the marker can see how the figure has been derived. Direct quotation from Student Accountant from the June 2007 exam, reported, of course, in the October. So always look out for these examiners' feedbacks. They tell you how people have passed in that sitting in the past, etc., and where people went wrong. So those feedbacks are eminently valuable. So let's run over that once more. An incorrect figure in an answer will not be allocated any marks unless the marker can see how the figures have been derived. I want you to put yourself in the shoes of the marker and see how difficult it is to give marks for a wrong figure if there are no steps. Remember, the markers are very busy. They need to get through huge amounts of scripts by certain deadlines, so it's all processed by the ACCA. So our task as students is to make the marking process easier, crystal clear, absolutely transparent, that you know it or you don't know it. So as long as you have your steps, for example, the most famous step, I suppose, is taking the group percentage, 80%, of the change in the net assets, which represents obviously the change in reserves. That is one of the worst done items in the entire examination. So it mustn't be us. We must show our steps. Right, let's move on to another interesting aspect, the single entity concept. When the parent has control over the subsidiary either through a majority holding of its voting shares or controlling its board of directors, it is considered a single entity along with its subsidiary. So, you are the parent. You be the parent, I'll be the subsidiary. You have 80% of my company. Clearly, I'm under your control. Now, would you agree that if we deal with each other, the concept must be to draw a circle around the entire group, and if there's any trading with the outside world crosses the boundary of the group, then you record it. But if there's any trading between us, it mustn't be, or at least it mustn't be shown in the group accounts, because we're treated as a single entity. Would you just highlight, underline, double underline that concept? Thus, intercompany transactions often held in current accounts must be cancelled. So would you underline, must be cancelled? And only transactions with the outside world must be reported in consolidated accounts. Also crucial in the exam is the application of something called substance over form. We report the result of the parent's ability to control, as I was saying, the whole of the subsidiary and not just the legally held 80% or whatever it might be. So there are things like the single entity concept, which is interwoven obviously with the substance over form concept, but the substance over form probably transcends everything else.